Natural gas futures slipped for a second straight session on Friday, with the September contract losing momentum after failing to carry Thursday's rally any further. The EIA's latest storage report delivered a bullish surprise, posting a modest 7 billion cubic feet build, well below market expectations near 10 billion cubic feet and far under the 5-year average injection of 29 billion cubic feet for this time of year. The smaller build was widely linked to a drop in wind power generation, particularly in ERCOT, which ramped up gas-fired electricity demand. Yet despite the bullish miss, the prompt month contract ended Thursday at $3.06 as traders quickly turned their attention to cooler weather forecasts for the eastern half of the U.S. heading into late August, a shift that is now putting the brakes on the bulls' advance. Meanwhile, for the week of August 9 to 17, forecasts point to a broad upper ridge dominating much of the U.S., driving highs into the upper 80s to 100s, particularly across the Southwest and Texas. National demand is expected to stay elevated over the next 7 days, bolstered by LNG feed gas flows averaging 15.5 billion cubic feet per day, a 10% increase from the prior week. Even so, market response has been subdued, as traders balance robust near-term cooling demand against the likelihood of softer weather-driven consumption beyond mid-month. Bearish supply-side pressures continue to offset bullish demand drivers. U.S. dry gas production reached 108.7 billion cubic feet per day on Thursday, up 5.7% from a year ago, while the active U.S. gas rig count climbed to a 2-year high of 124. This elevated output has been a major factor behind prices sliding to a 3.5-month low earlier this week, as the market remains cautious about sustained production strength heading into the lower demand shoulder season. Furthermore, if today's gas rig count update shows another increase, it could set the stage for an even deeper price decline next week. Despite the bullish EIA surprise and strong LNG export levels, the market remains firmly capped below $3.15. A failure to break through this ceiling could open the door for a pullback toward $3 and possibly $2.88. Stubbornly high production, elevated rig counts, and cooler late August forecasts for the eastern U.S. continue to weigh on the upside outlook. Unless prices can decisively reclaim $3.25 and build momentum toward $3.50, the short-term bias stays bearish, with traders likely to sell into rallies until weather patterns or supply dynamics shift in a meaningful way. Don't forget to like, drop a comment, and check out the previous video to help support the channel. See you in the next one.